This morning on BRN, does private equity belong in your 401k? Joining me now to discuss this, Allison Schrager is with the Manhattan Institute. Allison, so great to see you. Thanks for joining us on the program this morning.
It is. Thank you. Hope you have a good New Year as well.
It's 2025 is off to a good start. The market seems to be doing fairly well. There have been some spits and spats of some challenges, but hey, that's what the year seems to always be. Allison,
Markets do.
that's right. That's what markets do. They ebb and they flow. Um, Allison, I want to talk to you a little bit about private markets, in particular private equity, and the potential inclusion into 401k or 401k type programs. There seems to be a movement afoot. I guess my first question is, there appears to be a movement afoot to include these types of investments in retirement plans. And I guess my first question to you, get long-winded, is does this make sense?
No, not really. I mean, it depends, I guess, on how it's structured. But the argument is this, is that private assets have done very well for institutional investors, in part because they're illiquid and you get an illiquidity premium. So I think ergo, if you are in a 401k, it's also a long-term saving vehicle, so you should also get that benefit of illiquidity. And there's a point there. But the issue is I have with private assets, and I'm not against them per se. It's just, how they're being used and who's investing in them is I think what we always want to be thoughtful of, as we do with any asset class, is it isn't just illiquidity is the risk. I mean, there is no market pricing, which for me means less information, which for me makes it a lot riskier. Also, a lighter regulatory touch. I feel like over the years, with every financial blow up, we come to the conclusion that retail investors, particularly the least sophisticated ones who tend to be the retirement investors, need to be in well-regulated assets that are transparent. So the idea that there's this movement to put retirement savers in private equity seems completely contrary to that.
And look, there's $32 trillion, I think, the last count in U.S. retirement assets, and I think the great majority outside of pensions is in DC plans. So I can see the desire. And Allison, I mean, there has
I
been a
don't even
movement.
know if I do on the part of private equity, because yeah, it's a lot more assets under management, but it's also, do they want that level of regulatory scrutiny?
I don't think they. I can't speak. I'm not a manager, but I don't think any. I don't think the plan sponsors want the fiduciary responsibility. The last thing I think is someone who's coming into the marketplace using the to be a part of the existing regulatory strata probably can prove complex and challenging.
Yeah, and I think that's why I'm also concerned it could turn into this market for lemons, which is the really, private equity can mean a lot of things. Private credit can mean a lot of things, and not all funds are equal. Not all, even within funds, vintages are equal. I just don't see if you had a good fund that you would subject yourself to the regulatory scrutiny. So I imagine that, the slice of the industry that's maybe a little less compelling is what's going to go to the 401k market.
And but where would you put these? If where do these products are they best situated? Are they best situated? I can't imagine they'd be standalone investments like, hey, Jeff Snyder's going to allocate 5% of his money to private debt or private credit. They probably belong, if anywhere, in a target date or some type of managed portfolio on behalf of the plan and participant.
Yeah, at that point though, what are you getting out of this? I mean, these are also very high fee vehicles. So if you're packaging them together to get more diversification, like what are you getting out of this? It's not even clear. I've never actually seen a good compelling argument why this is truly even an alternative asset class. I mean, really, the evidence suggests that a lot of these types of private equity funds, and again, that can mean a lot of different things, is highly correlated with public markets. In fact, I read one paper where you could just lever up a value fund and get almost the same thing as a M&A fund, but with just much lower fees. So once you start packaging them all together, you also lose any, questionable diversification benefit. So then why pay the fees?
Well, I mean, and especially in today's retirement plan world, DC world, fees, we just went through fee regulations. I don't know, like 10, what was it, 2012? We had fee disclosure rules and fee regulations. And, the consulting world where I come from, had come from, has been all about how do you lower plan fees. I'm not sure that, I guess, is there an appetite to raise fees if the risk profile goes up and the return stream is better.
I mean, I said everything about this seems to be contrary to everything we've learned about retirement finance. One, that retail investors, particularly sophisticated, should have access to well-regulated, transparent assets and they should pay low fees. And this is the opposite of that. I think the appetite for it, one, coming from, private equity industry who wants the assets, is also, I think this whole thing with accredited investors rubs people the wrong way because you can only invest in certain assets if you have a lot of money. And that just speaks to a lot of people, this idea that markets are rigged. And I'm open to the idea that maybe we could revisit what an accredited investor means. But I don't know if we should start with opening up 401ks to private assets. That just seems to like jump to like 11 when maybe we could just maybe go to 4.
or 11, as they say in the movie Spinal Tap. Are there plan sponsors today? I'm just talking anecdotally. Are there plan sponsors today that are using these types of investments in their 401k plan?
I don't know. I mean, not on a big level. I mean, I know Apollo is getting involved in the annuity space,
Mm-hmm.
and I believe those products are available. But that I'm honestly a little less concerned about because what they're using private credit to finance annuities. And if they don't pay off, I think Apollo eats that. So, I mean, as long as Apollo, isn't going to run out of money and this is being properly regulated and properly financed, fine. If you're in some sort of, as said, insurance product that is backed by private assets and you're not on the hook if they underperform, I mean, like, all right, fine. I could be convinced, I said, assuming they are properly financed and this isn't going to pose some big burden to taxpayers down the line.
And what about plan sponsors? I mean, do you think that anecdotally, again, I'm not asking you to name a plan sponsor, but do you think they're amenable to these types of products and their participants? It would
I
seem to
mean,
me
I
that
imagine some are. I mean, it's hard to generalize. I mean, there's a million plan sponsors, but
yeah,
I mean,
there are
we've
quite a
already
few.
seen plan sponsors get seduced by all sorts of weird, high fee, untransparent assets all the time. Not necessarily with private assets, but all sorts of weird insurance structures because, these things sound good. You're promised always this holy grail of finance of, oh, you're going to have higher returns and less risk. You just pay 5%, 500 basis point fee, and this happens all the time, which is why, as I said, we keep learning what best practice is. And so, because I think we've seen plan sponsors can be easily seduced by this. Not all. I mean, it really depends on who they are and, who their consultants are and, how they view the meaning of fiduciary duty. So, but I imagine some would.
And what about the end user, the participant? It seems to me, the thesis with our network is that more education is better. Hence, why we've done close to 2,000 programs. It would seem that if you're going to include these, now the argument I guess would be, hey, these are underlying investments. They're part of a broader portfolio. You don't really need to disclose each individual component of the portfolio in great detail. But it would seem to me that education needs to be a big part of any investment that's included in a plan like this.
Yeah, I mean, there's also the question, which is, I don't see this as being QDIA. Like these just should not be a default. You shouldn't have such a high. I mean, I already think we already have too high a fee products as defaults, and that seems like the low-hanging fruit in terms of pension regulation. So, I mean, I suppose if you had it in the investment menu with appropriate education, like, all right, fine, I could be convinced that won't cause too much harm, but I can't imagine that many people will take advantage of it then either.
Yeah, I mean, look, self-directed brokerage. They added self-directed. Now I'm really showing my age, but we added self-directed brokerage to plans. And it was really at the whim, the result of maybe less than 5% of the population of an employee base wanting them. Right? They wanted to go outside the plan and mix and match and buy stocks and securities and ETFs, et cetera. Fine, they did that, but the usage of those things well below 5%, maybe even 3%. So the question becomes, go ahead. I'm sorry.
Yeah, most people don't want to do this. I mean, I personally obviously like choose my own investments in my 401k plan, but I'm weird and I also am devoted my career to this and usually end up replicating whatever the default is with just a lower fee basket. So yeah, so most people are happy to go with the default. I think that's fine. I think we have good defaults. You know, as I said, I don't like the idea of private equity in 401ks, but like if as long as it's not a default, if people really, really want to do this and hopefully they're getting well educated and good advice, then I suppose it could happen.
Yeah, I guess, hey, it's 2025. I guess we'll have to wait and see. Allison, so great to see you. Thanks for joining us, and we look forward to having you back on the program again very soon.
Thanks for having me.
And don't forget to subscribe to our daily newsletter, The Morning Pulse, for all the news in one place. Details, of course, at our website. And we're back again tomorrow for another edition of BRN. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.